Picture this. You're watching your investment screen, and silver futures are plummeting. Down 10%, down 20%, down 40%. Panic selling everywhere. The charts look apocalyptic. And yet at the exact same moment, coin dealers can't keep physical silver on their shelves. Premiums are skyrocketing. Wait times stretch from days to weeks. Physical silver demand has surged 250%. How is this possible? How can the same asset be collapsing in one market while experiencing historic demand in another? Welcome to one of the most fascinating financial paradoxes of our time, the complete divorce between paper silver and physical silver markets. To understand what's happening, we first need to grasp a fundamental truth about modern silver markets. There are essentially two completely different silver markets operating simultaneously, and they're increasingly moving in opposite directions. On one side, you have the paper silver market. This is where financial institutions, hedge funds, and traders exchange contracts representing silver, futures, options, ETFs, certificates. These are promises to deliver silver, derivatives based on silver, or shares representing silver stored somewhere. The key word here is representing. In most cases, no physical metal actually changes hands. On the other side, you have the physical silver market. This is where actual bars, coins, and rounds of pure silver exchange hands. When you buy a silver eagle from a dealer, or when a solar panel manufacturer orders silver for production, that's physical silver changing ownership. Historically, these two markets tracked each other relatively closely. The paper price was supposed to reflect the physical reality of supply and demand. But something has fundamentally broken in this relationship. When paper silver crashed 40%, it meant that futures contracts, ETF shares, and silver derivatives lost significant value in the financial markets. Traders were selling their positions, perhaps spooked by economic data, margin calls, or algorithmic trading patterns. The price on screens around the world plummeted. But here is where it gets interesting. That same crash triggered an absolute frenzy in the physical market. Savvy buyers saw this as an opportunity of a lifetime. The 250% surge in physical demand wasn't despite the crash, it was because of it. Let's dive deeper into how the paper-silver market actually works, because understanding this is crucial to grasping why the disconnect happened. The COMEX, the Commodity Exchange Division of the New York Mercantile Exchange, is where most silver price discovery happens. This is where the spot price you see quoted everywhere originates. But here's the shocking reality. Estimates suggest that for every ounce of physical silver that could actually be delivered on COMEX, there might be anywhere from 100 to 250 paper ounces being traded. Think about that ratio. It's like a casino that has issued 100 to 250 chips for every dollar it actually has in the vault. As long as everyone doesn't ask for their money at once, the system functions. But this creates enormous instability. When paper silver crashes, it's often due to massive sell orders in the futures markets. A large institutional player decides to dump thousands of contracts. Algorithmic trading systems detect the downward momentum and automatically pile on with more selling. Margin calls force leveraged traders to liquidate positions, creating more selling pressure. Within hours, the paper price can collapse. But here's the critical point. Most of this selling has nothing to do with actual silver. It's trading of contracts, many of which will never result in physical delivery. A hedge fund selling 10,000 silver contracts doesn't mean they're shipping 50,000 ounces to a buyer. They're just closing a position, often purely for financial reasons, unrelated to silver's actual supply and demand fundamentals. Silver ETFs add another layer to this paper market. When you buy shares of a silver ETF, you own shares in a fund that claims to hold physical silver. Some do this more legitimately than others. But even the most reputable silver ETFs create a buffer between the investor and actual metal ownership. You can't walk into the vault and take your silver. You own a promise, represented by a share price that can be manipulated by market dynamics having nothing to do with physical metal. Now contrast this with the physical silver market, which operates according to much more tangible rules. Actual supply and demand. When the paper price crashed 40%, something remarkable happened at coin dealers and bullion suppliers worldwide. Within hours of the crash, phone lines were ringing off the hook. Websites were crashing from traffic. Orders were pouring in at unprecedented rates. Why? Because physical silver buyers understand something crucial. The paper price crash represented a massive disconnect from physical reality. They weren't selling, they were backing up the truck and loading up. The 250% surge in physical demand manifested in several ways. Bullion dealers reported single-day sales volumes that typically take a month to achieve. The U.S. Mint's production of silver eagles couldn't keep pace with demand. Premiums, the amount dealers charge above spot price, skyrocketed from typical levels of $2 to $3 per ounce to $8, $10, or even $15 above spot. Here's what those premiums tell you. When premiums surge, it means physical demand has overwhelmed supply to the point that dealers can charge significantly more than the paper price and still sell every ounce they can get their hands on. It's the market's way of saying, the paper price is nonsense. Real silver is worth much more than screens are showing. Industrial buyers of silver also went into high gear. Solar panel manufacturers, electronics companies, and other industrial users of silver saw the price crash as an opportunity to lock in supplies at bargain prices. They started placing larger orders, further straining physical supply. Meanwhile, mining operations faced their own reality check. When paper silver crashes, miners don't suddenly discover massive new deposits or dramatically increase production. Mining is a physical process constrained by geology, labor, energy costs, and time. Many silver miners have all-in costs between $15 and $20 per ounce. When the paper price crashes below these levels, it doesn't make them mine more, it potentially makes them mine less. Several factors converge to create this historic disconnect between paper and physical silver markets. First, there's the sheer scale of leverage in the paper markets. When you can control $50,000 worth of silver with just a few $1,000s of margin, small price movements create enormous pressure. A 10% move against a highly leveraged position can wipe out an account entirely. This forces automatic liquidations that have nothing to do with silver's value and everything to do with individual trading positions. Second, algorithmic and high-frequency trading now dominate the paper markets. These computer programs respond to price movements, news keywords, and technical patterns at speeds measured in milliseconds. They don't consider whether physical silver supply is tight or demand is strong. They simply execute pre-programmed strategies. When algorithms all start selling at once, they can create cascading price collapses. Third, there's the issue of price suppression theories. Many silver investors believe that large financial institutions have incentives to keep silver prices artificially low. The reasoning goes like this. Major banks are short massive quantities of paper silver. If prices rise significantly, these institutions face enormous losses. Therefore, they have both the motive and the means to periodically engineer price crashes through coordinated selling in the futures markets. While controversial and difficult to prove definitively, there have been actual fines levied against major banks for precious metals market manipulation, lending some credence to these concerns. Fourth, the physical market has structural constraints. The paper market doesn't. There's only so much silver being mined each year, around 800 million ounces globally. There's only so much silver stored in available for-sale form. There's only so much refining and minting capacity. When physical demand surges, these bottlenecks create shortages that the paper market simply doesn't face. Have you ever looked at the price of silver and wondered why it feels so disconnected from reality? You see the spot price on your screen, but when you go to buy a physical silver coin or bar, the price is significantly higher. What's going on? Today, we're diving deep into the fascinating and often confusing world of silver, exploring the massive disconnect between the paper market and the physical market. This isn't just a niche topic for investors. It reveals a lot about how our modern financial systems work, and sometimes how they don't. Let's start with the basics. When people talk about the price of silver, they're usually referring to the spot price. This price is determined primarily in the paper markets, like the COMEX in New York and the London Bullion Market Association, or LBMA. Here, silver isn't traded in physical bars you can hold, but as futures, contracts, and other derivatives. These are essentially promises to buy or sell silver at a future date for an agreed-upon price. The volume of this paper trading is astronomical. For every 1 ounce of actual physical silver that exists for investment, It's estimated that hundreds of ounces are traded in paper form. Think about that for a second. The market is dominated by digital promises, not by the metal itself. This system allows for massive liquidity and makes it easy for large institutions, miners, and industrial users to hedge their risks. If you're a solar panel manufacturer, for instance, you need a stable price for silver. Futures contracts help you achieve that. So, where's the problem? The problem arises when the paper market and the physical market start telling two different stories. The paper market is driven by speculation, algorithmic trading, and large-scale financial maneuvering. It can be influenced by things that have very little to do with the actual supply and demand of the metal. A big bank can sell a massive number of futures contracts in a short period, pushing the spot price down, even if people are lining up outside coin shops to buy silver eagles. This is where the disconnect becomes glaringly obvious. Now let's talk about the physical market. This is the world of tangible assets. The silver coins in your collection, the 100-ounce bars in a vault, the silver used in your smartphone or electric vehicle. Demand here is driven by real people and real industries. When you decide to buy a silver coin, you're participating in the physical market. The price you pay is not just the spot price. It includes a premium. This premium covers the costs of minting, refining, assaying, insuring, and shipping the silver, plus the dealer's profit margin. Under normal conditions, this premium is relatively small and stable. But we are not in normal conditions. Over the last few years, we've seen these premiums skyrocket. We've witnessed periods where you couldn't even find certain popular silver products, regardless of the price you were willing to pay. Why? Because while the paper market was saying silver was abundant and the price was stable or even falling, the physical market was screaming scarcity. Mints couldn't keep up with demand. Dealers were running out of inventory. The supply chain, from the mines to the refiners to the distributors, was stretched to its absolute limit. This is the core of the disconnect. The price on your screen, dictated by paper contracts, doesn't reflect the reality of getting your hands on the actual metal. So what causes this divergence? A major factor is a loss of confidence. When investors feel that the financial system is unstable, or that inflation is eroding their savings, they often turn to physical assets like gold and silver. They don't want a piece of paper promising them silver. They want the real thing in their possession. This surge in physical demand puts immense pressure on a supply chain that isn't designed for it. Remember, only a tiny fraction of the silver traded daily is ever meant for physical delivery. The vast majority of futures contracts are settled in cash. The entire system is built on the assumption that most people will never ask for the actual metal. When a large number of investors start demanding delivery, it can create what's known as a short squeeze. This is where those who have sold paper contract short sellers are forced to go into the physical market to buy silver to cover their positions, driving the price up violently. We've seen attempts at this, like the silver squeeze movement a while back. While it didn't break the market, it certainly exposed its vulnerabilities and caused premiums on physical silver to explode. It showed that if enough people demand physical delivery, the paper price can become irrelevant. Another interesting aspect is the role of industrial demand. Silver is not just a monetary metal, it's a critical industrial commodity. It's in everything from electronics and medical devices to solar panels and electric vehicles. The green energy transition, in particular, is incredibly silver-intensive. As this demand grows, it consumes more and more of the annual silver supply, leaving less available for investment. This structural demand provides a solid floor for the physical market, one that the paper market sometimes ignores in its speculative swings. When industrial users start competing with investors for the same limited supply of physical bars, things get very interesting. So, which price is the real price? The paper spot price or the all-in price for a physical coin? The answer is, it depends on who you are. For a day trader speculating on price movements, the spot price is everything. But for someone looking to preserve wealth and own a tangible asset outside the traditional banking system, the only price that matters is the one they pay to have that silver in their hand. The premium is not an extra fee. It's the cost of entry into the physical market. It's the price of reality. What does this all mean for the future? Many analysts believe this disconnect is unsustainable. At some point, the paper market will have to reconcile with the reality of physical supply and demand. If confidence in the paper contract system erodes completely, we could see a dramatic repricing of silver. The price could break free from the paper market's control and be determined by what people are willing to pay for the physical metal. We're not there yet, but the signs of stress are visible. Widening premiums, the inventory shortages, the increasing demand for physical delivery, these are all symptoms of a system under pressure. Ultimately, understanding the difference between paper and physical silver is crucial for anyone interested in the metal. It's a tale of two markets, one vast, digital, and speculative, the other small, tangible, and grounded in real-world supply and demand. The growing gap between them might be one of the most important financial stories of our time. It forces us to question what price and value truly mean in our complex modern economy. Thanks for watching and taking the time to understand this complex topic. It's a fascinating space, and keeping an eye on it can teach us a lot. If you found this video helpful, be sure to hit that like button and subscribe for more deep dives into the world of finance and precious metals. See you in the next one. We live in an era of unprecedented financial abstraction. Most money is digital entries in bank databases. Most stocks are held in street name through brokerages. Most commodities are traded through derivatives. These abstractions work smoothly until they don't. Silver, like gold, represents something fundamentally different. A physical asset with intrinsic properties and thousands of years of history as money and as a store of value. You can't print more silver, you can't create it through fractional reserve banking, and you can't decree it into existence through central bank policy. The fact that physical silver demand surged 250%, while paper prices crashed 40%, suggests that a meaningful number of investors understand this distinction. They're voting with their money for tangible assets over financial abstractions. This shift is happening against a backdrop of enormous fiscal deficits, unprecedented money printing, and growing questions about the stability of fiat currency systems globally. In this environment, precious metals like silver aren't just commodities or investments, they're insurance policies against systemic risk. The industrial demand side of silver adds another dimension. Silver is crucial for solar panels, electric vehicles, 5G infrastructure, and numerous other technologies central to the economy's future. This industrial demand creates a floor under prices and competes with investment demand for limited supplies. So where does all this leave us? The paper-silver collapse combined with surging physical demand has revealed several crucial truths. First, price discovery in the silver market is broken. The paper price no longer reliably reflects physical supply and demand dynamics. Second, there's a growing bifurcation between paper asset holders and physical asset holders, with increasingly different risk profiles and outcomes. Third, the derivatives leverage in precious metals markets creates enormous instability and the potential for a historic squeeze if confidence in paper claims erodes. Fourth, physical silver's real-world scarcity becomes most apparent precisely when paper prices suggest it's abundant and cheap. For investors, the lesson is clear. Understand what you actually own. Paper claims to silver and physical metal in your possession are fundamentally different things with different risk and return profiles. Neither is necessarily better than the other, but they shouldn't be confused. The 40% crash in paper silver didn't make silver less valuable, it made it cheaper to acquire. The 250% surge in physical demand was the market's real verdict on silver's value. Thousands of buyers worldwide looked at the paper price crash and decided it was their chance to exchange increasingly questionable fiat currency for real metal. Whether this disconnect resolves through paper prices rising to meet physical reality, or through the paper market's credibility collapsing entirely, remains to be seen. But one thing is certain, the gap between paper promises and physical reality cannot widen indefinitely. Eventually, one or the other has to give. The smart money seems to be betting on physical reality winning that battle. After all, you can trade infinite paper contracts, but you can only deliver the silver that actually exists. And when the music stops, it's the people holding real metal who have a chair to sit in.